Good morning. Welcome to the show. We're half an hour away from the opening bell. Hong Kong, Shanghai, and Shenzhen. You're watching the China Show. I'm David Ingles with Yvonne.
Our top stories this morning: a cautious start for trading in Asia, with investors split whether stocks can sustain these recent advances. Onshore equities in China also in focus as momentum and turnover pick up.
ByteDance filing a U.S. legal challenge to its forced TikTok sale, setting up a battle that could make its way all the way to the Supreme Court.
And the U.S. set to revoke licenses allowing Intel and Qualcomm to sell chips to Huawei, further tightening restrictions against the Chinese phone maker. Overall, it is a quiet day here in Asia, but we basically have snapped out 4 days of gains here when it comes to the regional stocks here. So we're slightly down by about 0.6%. What's really driving that lower is the likes of Japan here this morning. We're down about 1% for the Nikkei 225. You're watching dollar yen very closely. That weakness seems to continue here. We're seeing the pop in the dollar a little bit. In fact, the Bloomberg dollar index has risen the most in about a week or so. So that weakness in the yen seems to be persisting now. There is some doubt of further intervention or suspected intervention could come for the currency here right now. So we're getting very close to that 155 level. Interesting enough, with the dollar gains, Treasury yields, though, are not really picking up. You're actually seeing declines for days now when it comes to some of the particularly in the long end of the curve, or the short end of the curve, I should say. We're at 42 right now. We're also watching those Aussie bonds after that RBA decision. Yes, they held rates, but not as hawkish sounding as the market was interpreting. So we saw a 10 basis point drop in yields yesterday. The 3-year yield continuing to see a bid here this morning. We're at 390 right now for the short end, and we're watching very closely what goes on with Brent markets. We're slightly just to the downside here today. Iron ore getting ever so closer still to that 120 level that it reached just a few sessions ago. We're also watching this key. So there's some earnings coming out. So Toyota's one. We had Budweiser brewing in Asia. Now this big trading debut in Korea. I believe it's the biggest trading debut we've seen in 2 years or so. This is Hyundai Marine Solution. This is a ship repair firm. There you go. Shares surging, so 41% here this morning. And we'll see how China plays out, right? So we talked about, we're seeing a lack of momentum in Hong Kong now. The Nasdaq Gold Dragon, you certainly saw some of these tech shares really falter a little bit here because these were the main sort of drivers of this rally of more than 20%. That's come off a bit here right now. You're seeing a little bit more profit being taken hold here. Looks like right now the Hang Seng snapping out of 10 days of gains. Looks like we're still poised for losses here this morning. We're down about 0.1% for futures, 229 for your Chinese 10-year yield, and 722 now. A bit of weakness in the currency, Dave.
Yeah, lots to watch in China today. As Yvonne is pointing out, it's also a day where we're looking at individual companies coming out. So we talked about Budweiser Brewing. SenseTime just came out and filed this filing with the exchange. We'll watch that stock very closely. SAIC is also one on the back of news out of Beijing news yesterday as it pertains to data in Europe. Apart from all of that, in the micro stories, Apple suppliers trading in the region. We'll get you an update really of this European trip and the Chinese president. We have a bill and also a bond auction today, 2026 bonds. CGB is about 120 billion, I believe. And in terms of markets, onshore market turnover, just under 1 trillion yesterday. So it's effectively over 4 days, about 1 trillion daily, or more so than average. And also just one last thing on markets today. So while we are losing some momentum here in Hong Kong, mainland markets are in focus. And we did just see that bullish cross on the Shanghai Composite, the first golden cross going back to about early 2023. More on that in a bit, but let's stay on geopolitics for now.
Yeah, China's ByteDance is suing the U.S. government to block a new law that would force it to sell TikTok or face a ban. It sets up what could be a prolonged court battle pitting free speech rights against national security interests. We did hear from the former U.S. Treasury Secretary Steven Mnuchin in saying he's still interested in buying TikTok.
Well, the Chinese government has been very clear that they won't give an export license on the algorithm, and I understand that. We have sensitive technology that we don't want to transfer to them, and they don't want to transfer this to the U.S. I do believe the algorithms could be rebuilt. So my plan, if we were to purchase it, would be to rebuild the technology under U.S. leadership, make sure that it's all disconnected from ByteDance going forward, and that it is very robust and secure.
For more, let's bring in our chief North Asia correspondent, Stephen Ingles. And Steve, what do we know about the details of this legal challenge?
I think I'm going to be talking about this for quite some time, obviously. This was a bipartisan bill that passed and Biden signed very quickly. It gives basically ByteDance, the parent company of TikTok, until January 19th of next year, so more than 8 months from now, to divest its stake in TikTok and sell essentially to potential buyers like Steve Mnuchin. I know that the former Google head Eric Schmidt had interest in buying it. There's been a number of speculations, whether Microsoft, Walmart was thrown in there, all kinds of different speculation. But now, essentially, TikTok's come out and said, yeah, we're not going to comply, essentially, and we're not going to sell. And they, on the grounds of, essentially, this ban signed by Biden is unconstitutional. It violates First Amendment rights of free speech and presents an illegal punishment without due process. Also targets a single company, that being TikTok, and it did not provide evidence that the app is indeed a national security threat. And that will be very interesting as well. That's a key point, because if this does go to trial and go to court all the way to the Supreme Court, undoubtedly the United States will have to supply some of that evidence that this is a national security threat. TikTok says it has spent more than $2 billion to isolate its U.S. operations. It's also agreed to have oversight by the software company Oracle. Anyway, it could all be moot right now because, again, it looks like it's going to be a long, potentially drawn-out legal fight.
Well, separately here, and certainly along the same lines in geopolitics here, Huawei, and the U.S. is taking some action there as it pertains to Intel and Qualcomm's business with Huawei.
And I think we have video of this. Remember, a few months ago, and I can't remember the exact time, Bloomberg investigators basically had that Huawei phone. They deconstructed it and found this 7-nanometer chip inside by SMIC, Chinese chip maker, that was made with U.S. equipment. So again, potentially in violation of this export ban to Huawei. So again, Huawei back in the in the crosshairs, if you will. Sources are telling Bloomberg that the U.S. has revoked licenses allowing Huawei to buy semiconductors from Qualcomm and Intel. And essentially that would mean, for Huawei products like laptops and also smartphones. And again, the smartphone market, that's what that one is being deconstructed right there. But essentially, the House Foreign Affairs Commission Chairman Michael McCall, a Republican from Texas, says this will block any chips sold to Huawei and also Intel. There are two companies that congressman says have a little bit too close relations with China. So again, for Qualcomm, they've already issued a statement recently saying that their sales to Huawei are almost non-existent and will eventually dwindle to very, very small numbers. But again, this puts Huawei in the crosshairs again, that if this goes through, if this is true, Commerce Department has said, yes, there's been some moves, but didn't give some specifics, but it would essentially cut Huawei off from all chips, including those 4G chips, which they're allowed to use right now.
Steve, thank you. Stephen Ingles, our Chief North Asia correspondent there. Just ahead here in shows, we'll take a deeper dive into the long May holidays, of course, and particularly with consumption. And Goldman Sachs actually came out with a report, so we'll unpack that with Michelle Cheng in a moment here. Of course, some fresh research showing perhaps a resumption of a consumption trend. We'll see.
Yeah, she says healthy is what she got from that data as well. But first, hear why ANZ doesn't expect the BOJ to hike again this year, but does see 2 Fed cuts on the way. We're going to talk a bit more about FX and strategies next. This is Bloomberg. Well, Minneapolis Fed President Neil Kashkari thinks it's likely that the Fed will hold rates until officials are confident inflation is under control. Speaking with Bloomberg TV at the Milken Institute Global Conference, Kashkari said that the Fed will do what's needed to hit its 2% target.
The second half of 2023 surprised us at how rapidly inflation fell. That was really good news, and the economy remained strong. We all hoped that was going to continue. The first quarter of this year, it seems like it's stalled out. So it's a little too soon to declare that we're definitely stalled out, or maybe it's just taking more time. I think we're in a good place right now. Labor market is still strong. We can take our time to get more data to see if disinflation is going to continue. And if it does, great. If it doesn't,
then we need to take that on board.
What is the complexion right now of disinflation? What actually drove us, at least down to the level where we're at right now?
Most of the gains that we saw last year were supply side improvements. Supply chains getting better, Americans coming back to work, a lot more workers entering the labor force. That's really positive. I don't think monetary policy actually brought demand down that much. And so most of the gains were because of the supply side. Now the question is, if monetary policy has to take us the rest of the way there, is it tight enough to do that? I wrote an essay today on our website raising that question. And I'm not sure how tight monetary policy is. We need more data to assess it.
How do we know that the disinflationary process has still some ways to go? Or how do we know that maybe this is it? This is the new normal?
Well, it's not the new normal because it's 3%, and the Fed can and will achieve 2%. The question is, if disinflation is still underway, then maybe it'll continue on its own, and we can then take that on board. If we need to hold rates where they are for an extended period of time to tap the brakes on the economy, or if we even needed to raise, we would do what we need to do to get inflation back down.
I have to just ask you, though, about 2%. And I know why the Fed stands by that 2%. But I talked to people around the room this week here, and their cost of capital, they're basing that more on closer to a 3% rate. And the idea is they're saying, look, the 2% target, that needs to come up. That's not the reality long-term structurally, at least not for the folks in this room.
Yeah, I disagree with that.
Yeah.
I mean, I think that ultimately the central bank, whether it's the Fed or the ECB or the Bank of England, can determine whatever the inflation rate is. And over time, if they conduct their policy appropriately, people will come to understand that, will adjust their behavior. We're committed to 2%. We will get to 2%. And we will get an interest rate environment necessary in order to achieve 2%.
Neil Kashkari there, Minneapolis Fed President, with our colleagues Carol Massar and, of course, Romaine Bostic. Right, let's talk about FX, and the FX angle to this is this dollar pain going away, and going away anytime soon. Mahjabeen Zaman joins us, head of FX research at ANZ. Mahjabeen, good morning. The dollar's been painful for most. I guess to borrow a phrase from John Connolly, former U.S. Treasury Secretary, it's our currency, but it's your problem. We're at 105 on the dollar index. I see you have a forecast here of 102. Take us down that road. What needs to happen to get us down to 102?
Look, we think the dollar in the near term, it will remain firmer, not stronger. And I think, just going back to the fact we started the year with roughly six rate cuts priced in to the market expectations. Today we're at 1.5. I'm sure we will settle somewhere in between. We're looking at 2 rate cuts, one in Q3 and one in Q4. And look, I think that weaker dollar momentum will eventually come. When we look at data now, yes, we are at a sort of an inflection point. We had U.S. exceptionalism all of last year into early this year. But, the global growth story elsewhere is also picking up. I mean, UK, Europe, they are coming back, and that growth exceptionalism is fading in the U.S. We think that's probably one of the reasons why dollar is going to move from, very stretched positioning, very overvalued positioning to a little bit of normal levels, if anything.
Okay, how does that affect the Bank of Japan in some ways, or maybe the Ministry of Finance in Japan? I mean, does that give them a bit of breathing room until they decide on what to do in policy? Yeah.
I think so. I think that will give them some breathing room, but I think that will only come Q3, Q4. I think in the near term, we have US CPI next week, and that's going to be telling in the direction and expectations of interest rate and the dollar in the short term. But I think in the near term, there are risks for a slightly weaker yen here. So we need to watch the Ministry of Finance and be wary of further intervention. Now, they do have over $1.2 trillion of FX reserves. It's easy for them to intervene. And I think the key concern from them is not just the volatility of the movement in yen that we have seen, but more so how it's impacting, and it's sort of pushing goods-based inflation, given that a lot of their goods, and commodities are imported, and that's going to impact the households, and that's what they don't want. They're looking for services-based inflation rather than the good side of things.
And on intervention, they've told us yet again a few minutes back that there's nothing to say, wait until the end of the month until we disclose the data. Do you think they intervened? That's one part. And number two is, what do you think the range on dollar yen perhaps will be over the next 3 months or so?
Look, I think, looking at the data, early indications of data, and also comparing to how we saw that shift in September, October 2022, we do think there has been some sort of intervention, but we will wait for the firm data end of the month. Having said that, we do see dollar yen stabilizing between 150 to 155 over the next quarter, and then only beyond, I guess, towards Q4, we see it strengthening below 150, 148 into year end, and further strength into next year. And that's really driven on dollar yen rate differentials narrowing, and that will likely come from the Fed side of things rather than the BOJ. We don't think the BOJ is going to raise rates, at least not for the rest of the year.
Oh, wow. Okay, yeah, so no hikes for the BOJ this year. And just interesting, though, I mean, does this mean that basically, if you look at developing or developed markets, they're just going to be at the mercy of the Fed for the rest of the year? I mean, is it going to be mostly a G10 story that we're going to see most of that depreciation, or at least that weakness or volatility, or is it going to be more on the EM side?
I think the EM side will continue to see a little bit of weakness depending on which currency we look at. But I think it really comes back to how much the Fed eases. We're just looking at 50 basis points now this year. We've adjusted for lower Fed easing. And obviously that carry differential, when you look at emerging market higher yielders vis-a-vis the dollar, generally you would tend to flow towards the better sort of the U.S. dollar side of things rather than taking a risk on the EM side of things. So I think that will hurt. On top, when you look at carry, we look at dollar CNY. Surely we have seen the CNY depreciate a little bit. The PBOC has allowed a little bit of that weakness to come in, but we don't think that they're going to allow consistent weakness or depreciation of the CNY because, the problem or the challenges that China has is around domestic consumption, not export, not really around the export demand side of things. And, the confidence around property space has to pick up, and a weaker CNY is not really going to do much there.
Since you brought it up, and, we've talked about maybe the two poster childs of weak Asian FX, yuan and yen. Some people, Mahjabeen, have brought up here in shows recently the risk of competitive devaluation is the diplomatic phrase. Do you think that's a risk that we should be cognizant over?
I think we saw Janet Yellen and, again, Bank of Korea, MOF, come together, pass those comments a couple of weeks ago. I think, this is sort of raising headlights if we continue to see dollar strength and yields move higher from here. But I find that, based on our views and, when we look at the U.S. data side of things, I don't think we are going to see much stronger DXY from here. We're going to stabilize at 105, 106. I think we've seen the peak for the year. Until we don't reach that, I think things are going to be okay. I think it's going to be more concerning if it reaches those levels upwards.
And there's still, other central banks like, the RBA, for example, just yesterday that, there was still speculation that they might still be able to squeeze in a rate hike this year. Do you think that they did enough to price out that possibility here, Mahjabeen? And what does this mean for the Aussie dollar?
I think that's really a great question. And, Australia is facing quite a similar issue than many of the other developed economies, and that's around the services inflation side of things and the wage growth side of things. Now, I think, we get our CPI here on a quarterly basis, so we need to really wait for Q2 CPI, and Q2 CPI has to be significantly lower or softer, especially on the services inflation side of things, for possibly the RBA to start easing in November. We're forecasting a November start, but I think there are risks to a later start depending on how that number plays out. And again, that's not the only thing here in Australia that's probably impacting inflation. We have a series of tax cuts coming in 1st of July. That's going to boost a little bit of consumption. We also have our budget coming up, a little bit of cost of living support coming in expected. And I think the RBA will want to take a back seat to see how these measures play out for the economy and how inflationary they are, if at all, and then decide how to move forward in terms of easing.
Final one for you. Tomorrow, Bank of England, what do you think they'll signal of when they'll start that path lower?
Look, I think Bank of England, very interesting. The three things we're looking out for. One is obviously their acknowledgement of how inflation on the headline side of things has fallen pretty drastically, and that's a good thing for them. Second, we're going to look at what their forecast looks like. But most importantly, we're going to look at the voting pattern. Last March, they had, 8 voted to maintain, 1 voted to ease for a rate cut. I think that ratio is really what's going to be meaningful to let us determine how sooner or later the BOE is going to start easing. We think that the BOE is going to begin easing in August. And again, 2 things driving that. One is services inflation that's still at 6%, very high. And second, wage growth needs to come up a little bit more. It's moving in the right direction, but it's not there yet.
Mahjabeen, great to have you here this week. Mahjabeen Zaman, their head of FX research at ANZ, joining us out of Sydney here. We're still counting down to that open in Greater China here this morning, and it looks like futures are still pretty much flat this morning. But there you go, Hang Seng pre-market still seeing a gain after we did snap out of that win streak yesterday. 722.88 for dollar China. That's 710. Once again, we're back to 710 levels for that fix this morning. This is Bloomberg.
Okay, what are we doing? About 5 minutes to the opening bell. 0.2% here, 18.5 right now. So we snapped the 10-day run yesterday. It looks like we'll be resuming regular programming. What is regular programming
regular
these days? Is the question. Anyway, looks to be going the opposite direction as onshore, which, by the way, is putting together some form of momentum here to the upside.
Yeah, it's interesting, though. It's not tech that's contributing to that so far. You take a look at what analyst actions are saying. Well, BOCOM, so the banking space, A shares raised to a buy at CLSA with a price target of 660. Jinko Solar rated a new buy at Pacific Securities as well. There was also some interesting lines from some of these solar panel giants saying prices are near that bottom. And Will Semi raised to outperform at CCB.
Yeah, finally. Well, if they're correct, of course, that the bottom in that specific sector and pricing and margins and the price war taking place is just ahead of us. A couple of stocks we're tracking. We'll tell you more about why we're looking at these stocks in a moment at about the open here. But just to give you a sense time has been a bit of substantial. And yesterday filed that with the exchange, of course, this deal on AF. Plenty more. Right? This is Bloomberg.
Welcome back. You're watching the China Show. We're counting down the open of markets in Hong Kong as well as in mainland China. And it looks like we might resume this rally that we're seeing in Hong Kong after 1 day of losses yesterday. So we'll see how this plays out. It's still pretty slow going so far. The rest of the region still looking pretty slow. Not a whole lot of conviction this morning. And futures are pretty flat in China as well. Dollar China, a little bit of weakness with the dollar coming back on the stronger side of things here. 722.82 this morning, Dave.
Yeah, but, at these levels, as our previous guest was pointing out, the dollar may have peaked, or in their view has peaked. That's ANZ at about 105. Remains strong, and then we go to 102 by the end of this year. 10 seconds to the opening bell. As Yvonne is pointing out there, we did snap the 10-day run in Hong Kong. We'll talk more about that in a moment. We're on a 2-day run up on benchmarks. On the mainland, of course, we're down a little bit right now, 0.25%, Shanghai Comp as well. We're looking at a couple of things and just a glance at some of the big names. Of course, they're bottom of your screens. At these levels at 31.41, 16% up from the bottom as well. We're also looking at, say, a 10-year yield, for example, and what we're doing in the CGB market. We have an auction coming up today, 2026 bonds, I believe. Bottom of your screens coming up, about 121, if memory serves me right, billion. That should be on deck today, as well as a bill auction coming out as well. Now, one stock that we're looking at in particular, and we'll unpack this fairly fascinating story in a moment, should be coming up bottom of your screens. Bubble tea, and one stock that's based on what's been taking place in social media, making its rounds, limit up on Monday, was limit up yesterday. There we go, Xiang Piao Piao. And paired gains into the close at about 1%. We're pulling back a little bit, 2.5%. Some nationalistic vibe coming through there. More on that later on. The open in Hong Kong, we should be higher a little bit at the open right now. We've done some research on this. Our colleagues at Bloomberg Intelligence, the tech eights, the big tech plays in Hong Kong. Tencent being one of them, Alibaba as well. Meituan should also be one, punching above their weight. right? 35% weighting on the benchmark MSCI China, 50% of the points contribution on that rally from the January low. More on that in a moment there. We're flat at the open. I take it back, 18.5 right now on that specific index. Earnings coming through out of Budweiser, 1.5% to the downside. A couple of other stocks we're tracking here, flip the boards very quickly. We're looking at, I think SAIC should be in here. This specific stock at the bottom here is actually issuing shares. We now know the range of 146.8 to 151.7 cents. Time did come out with that filing on the exchange yesterday. Strategic Cooperation Pact on Big Data and AI. A conversation and speculation on that on the street, of course, recently. SAIC, some news here coming through out of Beijing News, bottom of your screens. And Gangfeng Lit is looking to take, I think, 100% one of its specific mines, of course. I believe that's in Africa. There we go. In Mali, 342.7. 40% stake, my mistake there, on that index. I'll leave you with this. As we look for, Yvonne, more catalysts of what could push this rally even higher. From a technical standpoint, the first bullish cross here, Shanghai Composite 50 over 200-day moving average, first time since early 2023. We're looking for a fundamental story to drive this market even higher.
Yeah, I think because we have to probably wait for the next catalyst. I mean, earnings is one, but then you definitely have the plenum, right? That doesn't happen until July. So that's still a few weeks away. Yeah, we've been talking all about this travel data that we saw from this May Day holiday, right? Goldman Sachs says that retail and consumer sector data collected over that holiday week suggests things are looking pretty healthy in terms of overall consumption trends. Take a look at what they've been seeing and what they're crunching this morning. Total tourist visitation is up close to 8%, so that's well above that 2019 levels. Also, tourist spending up close to 13% as well. Retail, catering sales were also up. Here to bring us more is Michelle Cheng, co-head of Asia Consumer Research at Goldman Sachs. Overall, your take on these numbers so far and how sustainable they can be.
Yeah, thank you for having me today. And overall, we see the data set is healthy, especially it's on a very high base last year. If we review the recovery rate based on the multiple holidays last year, Labor Day holiday last year was the best. So on this very tough comp, and we think market has some concerns into the holidays, especially weather has been very bad in southern and eastern China. So expectation was come down a little bit. So with this data set, especially driven by tourist traffic, we think it's healthy. And if we look into more details for the recovery rate for this visitation, 28% higher than pre-COVID level. It's better than Chinese New Year and the Qingming holiday. And
but
also
per capita spending, that's still below.
Yeah,
29,
yeah,
right?
good point.
Yeah.
Honestly, consumers are still very rational in spending. So it's not only in tourist spending, so it's still 11% below pre-COVID level, slightly below Chinese New Year's. And also, even we look at retail data, quite a few shopping malls talk about double-digit traffic increase. But you can see the retail sales only up single digits. So ticket definitely still lower. So consumers are rational spending, but at least they are willing to go out. And also, if we combine the first quarter result we have been observed, pricing year-on-year is tough from a tough comp, but from the sequential perspective, we still see some stabilization. So incrementally, for some sectors like beer, spirits, sportswear, we see the pricing is actually more stabilized than before.
Right. So in which I was going to go to that because pricing is important here from the sort of macro inflation conversation. Where are you seeing pricing stabilize? You mentioned that if you could elaborate more. Along those lines. So first thing is inflation. We don't see any inflation, so it's very flattish this year. Okay. But if we look at into first half versus second half, first half definitely it's year-on-year still down for many categories. Since a lot of the promotion activities accelerated from third quarter, especially end of third quarter last year. Okay. So that's why like a lot of food service companies, including the big guys like Yum China, they still talk about a lot of promotion activities. Year-on-year is still declining, and also. Not only for food service, if we're looking at like snacks food, cosmetics, or even like prepared food. So some sectors with less competitive, less well competitive landscape, they are still suffering from price competition. But looking at apparel, I think there's still some bright side because inventory level is much better. So discount for sportswear is actually year-on-year seeing some improvement.
Okay. What are still other bright spots that you look at? I mean, obviously, we're seeing outbound, inbound tourism is still looking like it's come back in some ways. Obviously, people are opting for maybe cheaper sort of travel options, maybe not tier 1, but maybe tier 3, tier 4 cities. And like, how do you position position around this sort of emerging trend now?
Yeah, so one is lower tier city, that's still bright side. So not only during the holidays, but across the whole first quarter, we see lower tier city continues to outperform. Partially because if you look at income growth, lower tier city aggregate income growth is still slightly above from easy base. But on the other side, it's actually big brands. They are penetrating more into lower tier city. So historically, the lower tier city consumers, they probably don't have that many access to good brands. So with this access, the lower tier city opportunities is pretty decent. And outbound, you're right. If we look at outbound, Hong Kong, Macau probably a little bit disappointing. Again, bad weather. But looking at other countries, especially Asia countries, Singapore, Thailand, and also Japan, Korea, that's overall performing pretty well. And recovery rate is around 75%. Yeah, so outbound, I think, is showing a gradual improvement.
Well, so those are the sort of one-off spendings because of the travel holidays. What about sort of big ticket items, appliances, for example? What are you seeing, particularly as the government's trying to encourage some of these trade-ins, for example, for white goods?
Yeah, so our team did a few reports regarding this government policy, trade-in policy, etc. So the bottom line is definitely the magnitude, the impact won't be as big as a few years ago, but at least I think some support will still help. Yeah, so looking at the retail sales growth during the holiday season, the durables was actually the highlight. So on this 6.8% year-on-year growth during the holiday, the durables is a high single digit. So I think there's still some supports there. So hopefully with the overall economic activities stabilized and job market also slightly stabilized, and consumers is always a late cycle sector. So we need to see those the general macroeconomic activities stabilize, and then consumers will have more confidence to reduce the saving rate and to spend more.
Yeah, what was it that we saw with that Xinhua report that some of these online platforms are only offering what? I think it was 60 renminbi to trade in a fridge.
Yeah, to give your old fridge back in.
35 renminbi to trade in a TV. So there's not much incentive there.
No.
Does it require just more of the government push, adding more subsidies to some of these retailers? I mean, we've seen a lot of that in the industrial upgrades, but not so much on white goods so far.
Yeah, there's debate. I think on the one side, I think people hope to have more government support, but on the other side, I think overall government still quite cautious on directly issue consumption coupon, because the culture in China is definitely totally different from U.S. Even you issue those coupons, maybe the multiply effect won't be as good. Yeah, but I think ultimately, if we are looking for some incremental changes, improvement, I think at least, especially for some better competitive landscape sectors, we see some incremental improvement. And of course, that's also on a relatively low base in the market. Yeah.
There we go. How did you describe it? Rational spending?
Rational spending.
Yeah.
Rational.
Yeah. So I think last year people all talk about trade down. So we don't want to just talk about trade down, because the fact is some premium items are selling still pretty good. Yeah. So luxury, it's mixed, but some luxury brands is still doing pretty okay.
I like some of your preferred subsectors. White goods, apparel, beer, pet food, robot vacuum cleaners. That's new. And then premium spirits as well. That's new.
Yeah.
Can you tell us a bit more about those newly added sectors?
So one is some premium sectors still doing okay. So premium spirits and actually some luxury names are still doing pretty well. And even in sportswear apparel, you can see outdoor categories are doing pretty well. Outdoor usually is more premium in terms of price point. That's one thing. But the other angle for our preferred star is actually overseas opportunity. And some are structural, some are cyclical. So structural ones like white goods, like the cleaning appliance, and even like some retailers, we are seeing a lot of IP concept retailers, Miniso, Pop Mart. They are very aggressive expanding globally. So it's actually sitting in a very strong supply chain capability in China and a very competitive market in China, so that they can explore the white space there. But on the other side, if you look at the first quarter macro data, export data point is improving. So some consumer names actually related to export activity. So pet food, actually they are OEM. It's not a pure brand yet. And also apparel OEM, those Nike, Adidas manufacturers in China, not necessarily factory in China, but they benefit from the global restocking cycle.
Michelle, fantastic.
Yeah.
So much information in your head.
I love it.
That's amazing. Michelle Cheng there, co-head of Asia Consumer Research at Goldman Sachs. Okay, everything from pet food to premium liquor. Okay, speaking of premium liquor, the Japanese here in these markets, talking about their currency to be more specific here. So they might have actually taken some action against excessive FX. Again, teasing us with the language here. There is a risk that weak yen will be affecting underlying inflation. That's actually relatively new, them talking about the weak currency as something that creates some inflation.
It hasn't happened yet, right? We haven't seen that much impact on prices.
No, it's been good, generally speaking. Otherwise, they would have been firmer, I guess, in some sense. We are hitting session highs, though, as you can see on your screens. 155.14 here against the U.S. John, are you seeing anything else?
No. I mean, it seems like the traders are just kind of, you're set up for another battle, I think, against traders and what the government officials are trying to deal with, right? May have to take actions against excessive FX moves. So once again, putting out that possibility that they might step in.
Keeping us on our toes.
All right, we got plenty more ahead. This is Bloomberg.
Okay, so we're about 14 minutes into the cash market session here. And looking at the weakness coming through here in the CSI 300, 0.4%. Going the opposite way as yesterday, so some recovery taking place on the HS Tech Index. That's the market story. It's quiet, generally speaking. Let's pivot now and get you guys an update of this European trip, of course, of the Chinese president. President Xi Jinping, of course, has arrived in Serbia. That's the second leg of his European tour. He's looking to bolster ties with a country that's actually embracing Chinese trade and also Chinese investment. For more on the story, let's bring in our Asian government and economy correspondent, Rebecca Chung-Wilkin, to talk us through this. So France is done, cognac and cheese up in the mountains. He's now in Serbia.
Yes.
What's in the agenda? What are we watching out for here?
So he has arrived in Serbia on the 25th anniversary of the Belgrade bombing, which is a very significant moment for China itself. But more broadly, I mean, Serbia and then Hungary, these are two countries which are not just economically friendlier to China, but really geopolitically much closer to China too. Two rare examples in Europe of that. And that's primarily, or in a big part at the moment, because of that proximity, the closeness of the relationships between Serbia and Hungary and Russia here. As well as this sort of distrust of the US-led world order, that both countries are sort of big buyers of the idea of the multipolar world, and they're both BRI nations. So Hungary is the last EU country that is still a BRI nation after Italy withdrew from that, and they have both benefited in different ways, but from those mostly from those sort of classic infrastructure-style products. On the Serbian side, more on the sort of steel, on Hungary, more so on infrastructure, railways, and of course we're looking out for automaker developments here. We already know that the Belgrade government has said about 30 agreements may be signed between Serbia and between Serbia and China. So certainly more to look out for on that front too.
And it was enough for him to write a whole op-ed. It's called "May the Light of Our Ironclad Friendship Shine, the Path of China-Serbia Cooperation." You're saying this is getting a lot of hits right now.
Yes, a lot of interest in this. And it's just a fascinating timing here. It's really weighty timing for China because, yes, as I said, so she arrived on the day of the 25th anniversary of the Belgrade bombing, which happened in 1999. It is a really pivotal and important moment in the public consciousness in China that isn't always necessarily understood outside of China because it helps seed this mistrust of the US and this mistrust of NATO. And quite widely in China, although the US apologized, said it was an accident, there is still this feeling among many in China that actually this was intentional. And there is these suspicions around it to this day. And we have seen the government historically use this event to sort of dial it up and dial it down to try and stir nationalist feeling. So the interesting part of what this signals, not just these closer sort of reaffirmed ties with Russia and the world order, but also a signal for his domestic audience here too. A reminder of just where China stands, that it's showing a little bit of muscle despite these sort of warm ties with France, despite some of that thaw that we've seen with the US, still showing some muscle on the world stage about precisely where it stands.
Very interesting. Rebecca, thank you. Rebecca Cheng-Wilkins, our Asia government and economy correspondent, joining us on Xi's trip to Belgrade, of course. Well, Chinese businesses ranging from EVs to infrastructure will have much at stake as Xi continues his European charm offensive. His trip comes as the EU joins the U.S. in turning up its protectionist rhetoric. Well, our senior reporter for Asia Equities, Abhishek Vishnoi, is with us. I mean, obviously, we talked about what's at stake here and why this visit is important. Tell us what the market implications are really going to be, Abhishek.
The most important thing is that, this trip would show how much of the pain that China can manage, to LA when the Europe is going to a US-style protectionist sort of moves. Keep this context in mind that, market looks to have bottomed out. Some money has started coming in. Most of the outflows that have happened in China stocks have been from US-based investors. But if EU is also going the US way on most of the sectors, I mean, that outflow is yet to happen. So in total, this is going to test this budding rally, which has catapulted a lot of sectors into the so-called technical bull markets. So that's the most important thing. Other than that, there are a variety of sectors. So far, it doesn't look like, this trip has any sort of focus on chips, but there are a lot of new green industries on the radar.
Oh, tell us more, Abhishek. Don't keep us hanging.
Well, yeah. So in terms of green industries, EVs are the first one to come to mind. There are talks of higher tariffs that EU may impose. Some research analysts have been saying that 55% tariffs is what are needed, to make European cars, European EVs compatible with China, competitive with what China manufactures. So that's definitely going to have an impact on stocks like BYD. We have seen whole gamut of volatility across the spectrum of these stocks in the last few months in the backdrop of these concerns. Other than that, solars, renewable wind energy, wind turbine makers are also on radar. Names like Longai, Green would be on radar. There are talks of EU probes that may get completed in the next few months and how that shapes up the sector. Meanwhile, a lot of these solar renewable component makers have said that prices of their products have hit a bottom. So there is also a feeling in the market that just this outlook might be able to overpower these concerns from the Western world about China's excess capacity, right? Other than that, we have medical device makers also on radar and infrastructure as a sector. There's a big focus on the Belt and Road Initiative, what announcements and deals get introduced. And in that context, some, rail equipment makers like CRCC and battery maker Cattle, which is contemplating a plant in Hungary, would be on radar of investors.
Abhishek Vishnoi there, of course, a trader's guide here to the Chinese president's trip to Europe. Read all about that on your terminals, also on the website. Plenty more ahead here on the China Show. Keep it here. This is Bloomberg. Welcome back to shows. You're watching the China Show. Well, just a little bit of breaking news right now out of the Associated Press right now. So according to that report, the U.S. has paused the shipment of bombs to Israel to signal opposition to this ongoing invasion, of course, and offensive in Rafah. That's according to a senior administration official there based on that specific report.
Yeah, so maybe a bit of resistance there from Washington here this morning. Of course, we'll continue to watch what this means for oil markets and the like here today. In terms of what the rest of the markets are doing, we're watching what goes on. It looks like this Hong Kong rally is coming back. So we're seeing HS Tech gain about close to 1% now. So tech is catching a bid once again. We're back to around 18,500 levels here. On the flip side, though, onshore equities are actually faltering a little bit. We're down about a third of 1%. But MSCI China also doing decently well here today. And you're taking a look at what's going on. Vol's down. I mean, H shares are doing quite well as well. So maybe there's signs that things are continuing. But whether to continue to chase it, that's also...
Yeah, in fact, to help us out there, Morgan Stanley, Laura Wang, and Jonathan Garner put out a note. I believe this was late on Tuesday. We've written about that note and just really sort of fleshed it out for our clients right now that they're effectively warning Morgan Stanley against chasing the recent rally. One part of this is down to technicals, and some overbought signals could deter what was a key pillar of this in Morgan Stanley's view. Of course, a lot of buying from the quant funds. It's number one. And of course, this group of stocks have been outperforming the world really in the past month or so.
So there's no need to worry about FX and volatility anymore. You know, there's not that big of a need now to rotate
at this point. Yeah.
So
everything's in the price. Maybe
everything is about flows, right now. So certainly that's interesting. By the way, we're going to get Laura Wang on tomorrow.
Yes.
So you're going to hear from her herself about that view.
Yeah, stay tuned for that. That comes in tomorrow. But ahead of Laura Wang, of course, we have about 24 hours of programming left. And the next hour of programming, we're talking about African businesses in China. Of course, a bank there in Beijing. And of course, Feon of LinkedIn joins us next, too. This is Bloomberg.
Welcome back to the China Show. Here's a look at the HSI just a half hour into the session. It looks like we're getting a bit more of an oomph across these markets here. So we're actually rallying for, I want to say, 11th day out of 12 now, Dave. So certainly there's a sense that tech is once again catching a bit and really kind of bucking the trend that we're seeing across the region here this morning.
Yeah, although, you know, the gains are coming from different sources when you talk about tech. So, you know, the stories out of Apple, for example, and as you can see, the new iPad and some of the suppliers here pushing, at least helping push the tide slightly higher as well. And speaking of sort of other sources of oomph, Morgan Stanley and them talking about how, well, for one, don't chase the rally itself, but upgrading this specific group of stocks, of course, biotech, China biotech there on the back of a constructive with an underscore out of Morgan Stanley in terms of the second half. Okay, now, apart from that, though, as Yvonne is pointing out, it's actually a very quiet day across equity markets. And, you know, we were up past 10's 4 straight days on the regional benchmark, which, by the way, in case you missed it, was actually enough to push us to a 2-year high on the MSCI Asia Pacific Index. So overall, all things equal, including what we're seeing here in Hong Kong, actually seeing some weakness across Asia, ex-China, of course, and a couple of the sector movers are coming up on your screens very, very quickly to show you that as well. Currency markets, we'll get to that in a moment. Some interesting, newish comments coming out of Japan, for example, as it pertains to dollar yen. So 155, for example, on dollar yen. Do we have the other page? Thank you so much. Nikkei 225, 1% going into the last 30 minutes of trade. There's a big trading debut in Korea, the biggest one in 2 years, and a substantial gain on the first day, 40+%. We're headed into, of course, a couple of central bank decisions, most important of which will be tomorrow, of course, with the Bank of England. Just keep that in mind. Brent crude is seeing a little bit of weakness right now. Bloomberg Dollar Index, some strength coming through. And maybe, Yvonne, this is really why we're also seeing the reverse as it pertains to the Japanese yen. And that maybe some new context coming out of Japanese officials, putting the yen's weakness into an inflation conversation.
I like how Garfield Reynolds from the MLive team has said it. It's monetary policy jawboning, because what we heard from some lines
Put that
from
on a t-shirt.
Ueda, you know, he's basically saying that there's a chance that now the weaker yen is leading to maybe inflation, impacting inflation pressures, right? So we've never really heard officials talk about that. I mean, we haven't seen that really do much when it comes to inflation so far. So does that mean, and add to the case, that the BOJ might need to tighten policy a bit more? That's up for debate for now. But certainly, that, you know, the fact that what we're seeing with the Fed, it was interesting what we heard from ANZ earlier about, you know, maybe the dollar's reached the peak this year already, and it's not going to be stronger per se, but perhaps just firmer moving forward. That might give some leeway and breathing room for the likes of the BOJ, but they're still not thinking the BOJ is going to hike this year at all. Maybe first quarter next year, but really maybe rule out 2024 for now. So it's quite interesting. Traders are continuing to edge this trade higher. So it seems like they're still testing the resolve of Ministry of Finance here this morning. 155 levels that we've reached now for dollar yen. In the meantime, we got to talk about the Fed discussion as well. When we heard from the Minneapolis Fed President Neil Kashkari saying that rates could be on hold until officials are certain that inflation progress is on track.
I think the most likely scenario is where we are right now, which is just we stay put for an extended period of time until we get clarity on is disinflation in fact continuing or has it in fact stalled out. I don't think we know the answer to that, so I would say the most likely scenario is we sit here for an extended period of time.
Right, Neil Kashkari there, Minneapolis Fed President, speaking at the Milken Institute Global Conference in Beverly Hills. Let's bring in Mary Nicola out of our MLive team, of course, in Singapore. Mary, I mean, to be completely honest, it's absolutely boring out there. I'm being put asleep looking at my monitors right now. Wake us up with something, Mary.
I mean, it's a quiet week overall, to be honest, especially because you don't have any major data coming through. And plus, we had a very eventful week last week. So this is just the calm, more of a calm in the markets than anything else. But a lot of the key themes continue to resonate. So Neil Kashkari is coming out reaffirming what the Fed has told us, that there's obviously a high bar for any sort of rate hikes, and that rates are going to stay higher for longer. And that narrative is just going to continue. That narrative is going to stay within markets. But there is a sense of relief that a hike is not on the table, and that's going to keep markets going at least.
And you mentioned this sort of everything rally that you're seeing in the U.S. just leads to this dollar just to get more dominant, right? I mean, what does it mean for Asia FX? You think, it's interesting. Morgan Stanley is saying, it seems like those risks of FX and volatility and the like and rate differentials, that's something that's abating now. It's reversing. Do you see that view in any way?
No, I think especially if the dollar is going to stay strong, I think the pressure on emerging market currencies, especially in Asia, is going to linger. We're seeing that everything rally come through, so stocks are coming through. Same with treasuries are also having a better past few days. But we're also seeing the dollar coming in stronger, and that obviously weighs on Asian markets. Would you rather go into the U.S. Treasuries of the risk-free rate, or move your money into Asia, where you're not expected to get as a juicy of a yield or as an attractive of a yield? So that keeps the pressure on Asian currencies going forward. So and you're seeing it coming through in the yen, where the interest rate differential story is going to continue to dominate.
All right. Mary, thank you. We'll leave it there. Mary Nicola there, our MLS strategist, joining us out of Singapore. Still ahead, here by Bloomberg Intelligence thinks that Apple's latest iPads could give a boost to some of its Asian suppliers. Of course, they're adding some AI features and the like here, and talking a little bit more about that Apple Air laptop as well.
Yep, ahead of that, though, so we'll be talking with, and here's something new in Beijing. Welcome to China. Joburg-listed Absa International, as they open a new office in China, more and closer ties between Africa and China coming up next, and why they're doing this at this particular juncture. Plenty more ahead. You're watching The China Show. Good morning.
Yeah, we talk about the Africa show, but certainly there's a lot of investment from China that's heading into that continent. And then really we've seen this massive sort of evolution for the past few decades or so. And you're seeing this growing ties between China and Africa. If you take a look at FDI, for example, I mean, in the last 20 years or so, this basically has skyrocketed. The amount of Chinese foreign direct investment to Africa has basically reached the likes of $40 billion as of 2022. It's also helped in terms of this whole overall trade relationship. And you're starting to see a bit of transformation of where that money is going to. Of course, a lot of it has to do with what happened in infrastructure projects during the Belt and Road Initiative. It's now kind of transformed to more trade flows and more business opportunities in the continent, in particular when it comes to the mining sector, right? And you take a look at that, what has that outcome led to, right? It's basically meant that China has become Africa's #1 trading partner. And we're talking about basically $183 billion of trade that's been made as of last year. And that really outweighs, if you take a look at the other the top leaders here, the UAE, India, and the U.S. combined It just goes to show how big China's presence is now in Africa, Dave.
Yeah, and certainly predictability, right? In a world where everything seems to be in flux and everything else, this seems to be fairly consistent as far as flows. To Yvonne's point, trade and investments, right? And certainly capitalizing on those strong ties and predictable ties. South Africa's Absa Group is actually launching a non-bank subsidiary in China. Joining us now, in fact, to talk about this new venture out of Beijing is Cheryl Butts, Chief Executive at Absa International. Cheryl, well, first, a pleasure to have you to the show. Good morning. Congratulations, by the way, in the new endeavor. A lot of questions. Let me get started by just clarifying non-bank unit, non-bank subsidiary. So what exactly is the business and what can you not do?
Good morning, and thank you for having us on the show today. Absa is a Pan-African bank with a headquarter in South Africa. We're setting up a wholly foreign-owned entity in China, which is essentially a non-banking subsidiary of Absa Group. And really what it allows us to do is capitalize on the trade and investment flows that we're seeing in both directions, not only from China into Africa, but also from Africa into China. And having the presence in Beijing allows us to capitalize on those flows by building close relationships with Chinese investors, state-owned enterprises, the private sector, the Chinese banks, which we see have an increasing interest on the continent, as well as development financial institutions. So by being here and providing advisory services about Africa, we represent Africa in China. I like to say that we're the face of Africa. And so by being present, having a close presence, allows us to build these relationships, be that face of Africa, and build that connectivity back into the continent.
And how much of a risk appetite is there among Chinese companies now to invest in the continent? What are you seeing, and why do you think now is the time to set up this office in Beijing?
The trade and investment flows are inextricably linked. The economic ties are inextricably linked. We're seeing so much cooperation between government, between private sector. That's illustrated via FOCAC, the various FOCAC summits. It's illustrated via the China-Africa business forums. And we're seeing increasing not only investment, but also trade flows. We're also seeing a cooperation and development around trade flows that go into Africa, as well as looking at how we can export product from Africa into China, the likes of agricultural product, the likes of products that have been that are already at the end of the cycle from an agricultural perspective, and really just linking the two is critical for the development of the cooperation between China, Africa, as well as the development of the African continent. And as you've rightly said, we've seen huge investment flows. China is the biggest bilateral trading partner with Africa. And just to use South Africa as an example, we've seen trade flows in South Africa increase from $1 billion to $56 billion in the past 25 years. So surely just an illustration of how close those ties are and how that cooperation is extending well into the private sector as well. We see a lot of opportunity with the private sector as it also looks to various sectors across Africa. We've touched on mining and minerals that you mentioned earlier. Power, renewable energy is obviously a key focus. Critical minerals, we're seeing a huge growth around critical minerals under the guise of ESG development.
Right.
So really exciting across a number of wide sectors.
It seems that there's really, and I wouldn't say it seems, there really has been a story there, just to rephrase that, Cheryl. So let me rephrase my other question. Instead of why now, why only now then?
Africa is obviously on a development path. Absa itself, we have a strategy around looking at various global territories for international expansion. And that international expansion is really about connecting us into the continent. We're an African bank, and we don't purport to be anything other than having a wide Pan-African presence. So we do have international offices in other territories. countries. And this was now the time where we believe that our clients, our partners were saying to us, we'd like to see you in China. We want to see you committed to China. We want to see you committed such that we can build those partnerships, those ties, and look at trade opportunities across the continent. So the time was right in our broader strategy, and it's really exciting to finally be here.
How does the China market then contribute to your earnings in the future, at least in terms of projections on trade revenues, in terms of revenue growth? What sort of targets are you looking at right now, Cheryl?
We're looking at building relationships such that we can. What we're really looking to do is support the growth and the development across Africa. And we believe that the trade and investment targets of private sector and of government are substantially enough that warrant us setting up the office here, having the opportunity, and naturally looking at the commercialization for ourselves as a bank. So we certainly have ambitious targets, but it's not only about commercial viability, it's about how we ensure that we align with the various corporations, how we ensure that we put Africa on the map, and how we ensure that we connect the continent into the greater world.
Cheryl, so talk to us about then, how you're looking at measuring the success of this new endeavor. What's the scale of the business ideally you're looking at on the ground in Beijing for the next 12 months or so? Are you looking to hire people? Where's the office going to be? And talk to us about the journey of just getting this started, as there are some doubts in the world about, is China open for business? Just talk us through the counter narrative there, Cheryl.
Thank you. China's very much been open for business in terms of our setup. I have to iterate, though, that when we're here, we're not purporting to be a bank. We're an advisory consulting firm in China, and everything that we do will be about Africa. So the transactions that we commit to are going to be supporting our African businesses. We operate in the continent in over 12 countries, and so the office here is really to build the ties such that we can help Chinese firms, Chinese private sector, Chinese banks navigate the continent. So when we look to execute and provide support on the continent, it's anything from corporate advisory all the way through to retail banking and everything that may be touched in the markets in which we operate. Execution, therefore, is in the markets in which we operate. So any types of trade finance, any types of advisory, lending activities, working capital to support Chinese businesses that are operating on the continent. That is where we will be executing. That is where we will be transacting with these corporates. And that's how we hope to leverage opportunities not only for ourselves, but of course for Chinese institutions operating on the continent.
I was going to ask, are there risks to doing so? I mean, I'm just wondering in terms of what we've seen in the past, whether it's on infrastructure projects or like, there is this concern of debt trapping of African countries that are left with this debt burden from as a result of Chinese loans. There's been cases of lack of transparency and accountability in some of these Chinese-led projects as well. I mean, how do you navigate around those risks?
Yes, there have been these challenges, and we continue to see challenges across Africa. However, Absa will always look to support and do things in the right way. We would not be reckless in terms of how we do business and any debt structures that we would put across. Yes, there are significant infrastructural challenges across Africa, but by that same token, there's significant opportunity. When you look at the opportunities that exist across the power sector, across renewables, especially under the guise of deepening ESG, there's certainly opportunities. Infrastructural development, it's estimated that there's over $100 billion per annum required in order to close that infrastructure gap. So the opportunity certainly does exist. That being said, of course, naturally, as in with any market, there are natural headwinds that we expect, and it's how we navigate those macroeconomic challenges carefully, how we do it responsibly, working with Chinese institutions, as well as working in our countries with private as well as with public sector.
Cheryl, it's good to have you here in the region. Cheryl Buss there, Chief Executive of Absa International, joining us from our Beijing studios. We got plenty more ahead. This is Bloomberg.
Welcome back. You're watching the China Show. Wow, check that out, huh? Hindsight, right? There we go. The biggest trading debut in Korea, South Korea, in about, 2 years or so. Massive first day for Hyundai Marine Solution there. The ship repair firm starting trading in Seoul, of course, today. This follows Asia's second largest IPO this year, of course, helping consolidate South Korea as one of the region's top venues for share sales. Felipe Pacheco is with us here on set, our equity capital markets reporter. As we see these shares jumping, what's particular about this specific listing?
David, I think it's great to be here to talk about good stories, right? It's been a while, and South Korea is definitely a market that's getting a lot of attention. When you talk to bankers, this is one of those places that they want to talk about, and I think that this is a very, very good example of why. This is a very interesting company. It's part of the Hyundai Group. It's a company that's specialized in actually repairing and providing services to ships throughout their life. It's a very unique business. South Korea is very strong in that segment, of course. And then you have the fact that we haven't seen large IPOs in Seoul for a while. The last time we had a deal that was actually larger than $500 million was LG Energy Solution, that massive deal back in January 2022. So there has been demand. There's the positive story when it comes to shares, and the corporate is seen in South Korea as a whole, given all of the reforms they are trying to implement, the boost to the corporate sector that is coming from the stock exchange, from authorities. So it seems like this is the right moment. Momentum is building, and there's been excitement also in the secondary market. Large blocks coming to market, pricing very well, and performing very well once they are out there. So now the big question from our side is, are we going to see more deals and doing quite well at the first day?
What are you hearing? Are we likely to see more of these sort of mid to large deals in
I
South
think
Korea?
it's fair to say that yes, Yvonne. As I said, bankers are quite optimist. We have bankers here in Hong Kong that are constantly working with their offices, with their bankers in Korea, and they are all excited. They are telling us that there is a pipeline that's building up. We see more deals from different sectors. That's a very interesting point when we talk about Korea. We are not restricted to industrials. We are not restricted to tech, for example. They used to dominate the deals back in 2020, 2021. You have consumer names that are quite big. You have names that are tied to cosmetics that are actually quite relevant and quite important within the domestic market, and are also non-internationally. Those are very good candidates that could actually be giving activity to this pipeline, and we know that there is appetite from the retail side and also from the institutional side to provide support to those IPOs.
So those are sectors, just very quickly, what other markets might be active here?
I think anything tied to cosmetics, to retail, to consumption. We've seen smaller deals coming to market earlier this year, and they did quite well. Okay. So it's one of the sectors that would provide us some good stories in the future as well.
All right, Felipe Pacheco, watch out for those cosmetic makers, he says. All right, joining us here on talking about this debut of today, it's about ship repair.
Yeah.
We're taking a look at when it comes to some of these markets, and we're talking about it is a declining story when it comes to stocks here today, but you are still seeing some decent moves when it comes to earnings. So Toyota comes up next when it comes to results. Nintendo, though, there you go. You're seeing shares drop close to 4.5%. So full-year operating income forecast missed estimates. They did talk, though. There might be a Switch successor coming. Finally,
switching it out. We have to wait.
Teasing.
We have to wait. Do you have a Switch?
Yes.
Okay.
It's retired since COVID, but yes, I've been waiting for the next one.
Yeah.
So we're watching the likes of
Nintendo.
Mitsubishi Heavy Industries, Crafton as well. So
GameMaker.
Those are all coming out with earnings a little bit later on. Solar stocks, though, that's an interesting one to watch.
Yeah, this is a China story too, and the solar panel giants are saying the prices are near the bottom here. So Petrina chairman Jinko also coming out, a joint presentation hosted by the Shanghai Stock Exchange, and the message here is this current slump is irrational, and there's only a small probability it will continue. We'll leave you with maybe a glimpse of the sunrise over the horizon just ahead. Also, the lunch break in Japan is upon us. This is Bloomberg.
All right, Nikkei 225 is doing this, heading to that lunch break. We're slightly down here this morning, and the Topics is actually feeling it as well. So we're seeing declines, and really the main drag across Asia equities here this morning seems to be coming from Tokyo. 155.20. We're on the weaker side of the yen here this morning, and really, is there a risk now of what was suspected intervention and all that unraveling? Certainly, we're hearing about this meeting between Ueda and the Prime Minister. That's causing a lot of chatter.
Yeah.
But yeah, they're still saying what on intervention? I don't know.
Well,
they'll move if they need to.
They'll move if they need to. We'll tell you what you need to know at the end of the month. Although the fact that, and Garfield, our colleague, pointed this out, right? The fact that they're bringing in potential inflationary concerns around the higher exchange rate might be the initial signal that they're ready maybe to go. Again, session high is 155.22 there on dollar yen. Right, as Yvonne is pointing out there, because of what's happening in Japan, really pulling down what we're seeing broadly speaking, and as you can see, not just in Japan and certainly across most sector groups on your screens, and you're looking at everything from IT all the way to healthcare, with the exception of energy and real estate. Well, real estate, we're being generous because that's effectively flat. We're seeing some weakness across the board here. That said, we're also coming off quite a weak session on Wall Street, and on top of that, the Chinese rally has stalled, and Morgan Stanley says at this point in time, don't chase this. Let's wait things out to tell us more, to tell us why, really, they're coming on the show tomorrow. So stay tuned for that conversation with Laura Wang out of Morgan Stanley. That said, one pocket of this market that's doing quite well in this equity market are some of these suppliers of Apple listed in this part of the world. Maybe it's because of this new iPad.
Yeah, I mean, let's show it, right? Unveiling this new AI-focused iPad Pro model as well as a larger iPad Air. And what they're really hoping for is maybe this could reinvigorate this tablet lineup that has basically languished over the past 2 years. So it was an online launch event that happened yesterday. It's called Let Loose. This is the first redesigned version of the iPad Pro since 2018, Dave.
It's been that long?
Yeah. It's thinner. It's got a crisper screen with OLED technology, I'm hearing, and a faster M4 chip that can handle AI tasks as well.
Because it previously was an M2 in the iPad Pro, so maybe that's new as well. A new OLED screen. I'm just looking through some of the components here as well, because that's really what's tradable across this market. And alongside the new hardware, Apple also came out with the Final Cut Pro. Okay, that's different. Okay, let's talk about this, and in the broader context of markets here in the Asia Pacific. Let's bring in Bloomberg Intelligence right now. Of course, they think that this new iPad could actually boost panel suppliers, and we're talking names like LG Display, Samsung Display over in South Korea. Our senior analyst, Stephen Cheng, is with us right now out of Taiwan to talk us through this. Well, Stephen, we'll start with this. Tell us about this, the latest list of Apple products and how they could help a lot of the companies in this part of the world that really depend on Apple and that product lineup.
Yes, hi. I think obviously this new iPad Pro has two major hardware upgrades. One is about M4 chips, and the other is about the upgraded display, which is the first time they introduced the OLED display in their computing devices. So apparently M4 in Asia should benefit TSMC as usual. And then as for the OLED display, I think LG Display and Samsung are going to benefit from that substantially. And longer term, maybe is the first step that Apple start to actually use OLED display in the computing devices. So maybe MacBook gonna be the next one. Is a new future. Yeah.
Yeah, you're mentioning some of these beneficiaries. That's really the likes of some of these Korean suppliers, right? So what is the latest supplier list that we've seen from Apple? Does it show more evidence of decoupling from China?
Apparently, the diversification has been there, right? If you look at the latest supply list in terms of the location of factories, we do see the consistent increase in Southeast Asia. Well, interestingly, if you look at what happened in mainland China, the percentage is still very high. The last year is about 36% of the Apple supply chain factory are located in mainland China. That percentage was slightly down from 38% in 2022, but still higher than 35% in 2021. So that means that even though people are talking about decoupling, the pace apparently is still slower than some may expect.
And, you know, tell us why that remains so. You know, the reliance of Apple and its supply chain on mainland China, but why is that still high and relevant at this point in time?
Okay. Actually, I think obviously China has been the one of the major manufacturing hub for tech product for a long, long time. It has some very clear advantage, such as the talent pool. It has a lot of the skilled labor engineers, and also it has a very comprehensive supply chain of components and material. So those benefits and those advantages are actually still hard to match by other regions. So when we're talking about Southeast Asia, we're talking about India, obviously they're picking up. We see Apple start to move some assembly capacity to those areas. But in terms of component, the relocation is still quite limited. So unless things are catching up in those areas, I think China will remain very important in Apple's supply chain.
So you mentioned a little bit more of that. Do you think ASEAN or India will be able to replace then China's role in Apple supply chains in the coming years?
I think, longer term, anything is possible. But if you look at, say, next 3-5 years, I think it's going to be quite difficult. For example, I think everybody knows that Apple is now making iPhone in India. But we're just really talking about assembly. I mean, they still import pretty much all the components from China to India for the iPhone assembly there. So it means that if there's no local component supply chain in Southeast Asia and India, then it's hard to actually create any genuine threat to mainland China's position. So let's wait and see. I mean, obviously, it takes China like 2 to 3 decades to have that kind of comprehensive supply chain. So it takes a long time for Southeast Asia and India to replicate that ecosystem.
Stephen, fantastic work. And for our viewers and clients, do check out Stephen's work, of course, BI Go on your Bloomberg terminal there. Right. Also on BI today is this sort of dissecting of and this is still tech, but the rally taking place, and you're laughing, here in Hong Kong. And what are we calling this group? What are they calling it?
Well, Marvin Chen, he calls it Tech 8. I don't know if he came up with that name.
Yeah. It's quite creative, though.
I mean, it's interesting, right? They're basically saying this is China's answer to the Magnificent Seven in the U.S. And because of what we're seeing, right? Because this Tech 8, so I have to list out the ones that he's talking about. So Alibaba, Tencent, Meituan, Pinduoduo, NetEase, JD.com, Baidu, and Xiaomi. Okay. It's hard to put an acronym on all 8, right? So that's why we call it Tech 8. But if you look at it, the weighting that these 8 companies have on MSCI China is huge, right? Yeah. It's about a third of it. And you mentioned about the rally impact. I mean, it does have about 49% of
the impact. So it's carried the index on its shoulders when we talk about what's really outperformed since the bottom in January.
Yeah.
And it looks, to your point, it looks eerily familiar to the way that Mag 7 have actually lifted and continued to lift
50% of returns on the S&P.
On the S&P, right? So we have our version of that here.
But the difference is valuations are lower; they're cheaper here.
Completely just.
So
it's
therefore, there might be more room. That's according to Marvin Chen. So
if the earnings, and actually this is maybe a story for next week. You have a lot of the big China tech earnings coming out over the next couple of weeks or so. So whether you're getting that fundamental support for this rally and earnings coming through, we'll find out. Which is interesting because NVIDIA also comes out, I believe, on the 22nd of May. So, mano y mano.
Who's going to punch their weight more?
Yeah.
All right.
Yeah.
It's a good
Stay tuned for that fight
though.
card.
Yeah. So we'll continue to watch that. Of course, we'll get to see Marvin Chen on when it comes to this whole Tech 8 earnings story as well. We're also been hearing from the former Google CEO Eric Schmidt saying the U.S. is way ahead of China and the rest of the world when it comes to AI. Schmidt has made the U.S. rivalry with China a top focus through an initiative called the Special Competitive Studies Project. He spoke to us from their conference in Washington.
Well, the good news is the U.S. is way ahead of China and everybody else, and I think that's going to continue for a while. To me, national competitiveness is the challenge for the next 10 or 20 years because the Chinese are really focused on dominating certain industries, and we need to compete with them and make sure we win. In the case of artificial intelligence, we are well ahead, 2 or 3 years probably of China, which in my world is an eternity. I think we're in pretty good shape. And the crazy valuations, all the money, all of the new experimentation, this sort of enormous adoption of AI that's occurring will have a lot of implications on society and very good for business.
What about, well, ultimately, the pace of regulating artificial intelligence? Is there any risk that we stifle innovation in so doing?
There's always a risk of premature regulation. My simplest example there is Europe. I spent 10 years trying to convince Europe to actually innovate instead of regulate, and they just keep regulating. The current EU Act, AI EU Act, is essentially regulation, not investment in the future. So you can see that Europe is highly unlikely to be relevant. China, of course, is struggling because of chip shortages and so forth, although they're ready to win if they can get the hardware that they need. And the rest of the world is not focused enough on this. So the good news from my position in terms of America, here we are in DC for national competitiveness, we're the likely winner if we don't screw it up.
I'm really interested, you say perhaps China's being pushed behind because of its lack of access to chips. Are we currently navigating that nuance well?
Well, the Trump administration, followed by the Biden administration, did a good job in getting those rules in place. It's a good example and not a common example of how a targeted intervention has a positive measured outcome from the standpoint of the national security. So I think we're good there. It's very important, and I led the National Security Commission on Artificial Intelligence a few years ago for the Congress. It's very important that we get more basic money out of the government for basic research. We're building intelligence. We're building a new form of non-human intelligence that will change the world forever in a good way. And furthermore, it needs to be done with our partner countries. These are the Five Eyes, the UK, that sort of thing, some European countries. And also it needs to be done with American values. So using China as the bogeyman, imagine if they were in charge of the internet and they were in charge of the rules. Can you imagine how very different your experience as a user on the internet would be? Today, you can show up, you can be anonymous, you can do whatever you want within reason. That kind of freedom is central to the spirit of the internet, and it's important to be preserved.
Talking about a bogeyman and a Chinese-related bogeyman, TikTok became the bogeyman that many are now trying to regulate, to indeed ban or to sell. There's been some reporting that you've been interested, alongside Mnuchin, in potentially purchasing US TikTok. Would you still be?
I'm not currently looking at that. I looked at it for a while. My personal view on this is you're better off regulating than banning or a judicial action. All the big tech companies are now in the hands of the DOJ in various legal fights. I would prefer to see a regulatory regime that is sort of has the right incentives and the right prohibitions for all of these things. My own view of TikTok is that TikTok is not really social media, it's really television, and that you can regulate television by the equivalent of the equal time rule, but somehow we're not having that conversation.
What's interesting is, of course, you say many big tech companies are currently, well, entangled from a time perspective with the DOJ, one of them being where we know you helmed from, of course, the previous CEO of Google. Where do you rate, from a personal perspective, where Google is in the AI competition race?
Well, it's interesting that almost all of the technology you're seeing today was invented at Google about 5 to 10 years ago. And it's one of the sort of great things that during that period, Google had a roughly, in my estimate, 2/3 of the world's talent in AI was working at. So Google had a very, very strong head start. I think Google is a complicated place. There's a lot going on. OpenAI, in particular, came out with GPT-3, 3.5, and 4, and did a fantastic job. I think that was the competitive nudge that has gotten Google back in the game. What I like now is you have these two huge companies, Microsoft and OpenAI together, and Google Alphabet, again, operating together, and you have them putting billions of dollars of hardware and enormous software teams to invent this new future. This is not to take away from Anthropic, another competitor. Obviously, whatever Elon is doing with X.AI, he's raising a huge amount of money. And Meta has recently released a $400 billion parameter modeler is in the process of relating it that looks really, really good. So that competition is the right answer to the regulators and to everyone's question. Competition brings out this enormous value to consumers. And eventually people will see this and they'll say, oh my God, look at what this does and it's free. And of course, all that money was paid out of the markets, the billions of dollars that's going in right now, and they'll monetize it somehow.
The former boss at Google there, of course, Eric Schmidt, speaking with our colleague Caroline Hides. Along those lines, same lines, this next conversation on the other side of this break, of course, we're talking jobs, AI, upskilling, where we are in this layoff cycle, particularly when you look at the financial sector here in Hong Kong. LinkedIn joins us. They give us their Asia-Pacific outlook. Just ahead, stay tuned for that. This is Bloomberg.
Welcome back to the China Show. Bloomberg has learned that JP Morgan is starting a new round of layoffs in the region, cutting at least 7 more investment banking jobs. Now, sources say the reduction started this week, impacting staffs in sectors including consumer, energy, and healthcare. JP Morgan cut jobs twice in Asia last year, joining rivals including Morgan Stanley and Goldman Sachs as deal flows in China and Hong Kong have slowed.
Yeah, it's tough. It's tough out there.
Yeah.
Including that early cut to us. I'm sorry if you caught me. I was fixing my shirt. We want to look good for you guys. Continuing that conversation on the jobs markets, short and longer term trends. Joining us here on set is Feon, APAC Managing Director at LinkedIn. Good morning. It's nice to see you here.
Hi.
In Hong Kong.
Thanks for having me.
We'll talk about what brings you to town in a moment, but we were talking about how soft this job market is in Hong Kong. Financial services is a key industry here in Hong Kong. What are you guys seeing on your platform as far as data goes and where we are on this job cycle, for example?
Well, we're definitely seeing a wave of demand for AI skills, and you find that the hiring demand has grown by 300%.
Wow.
Just hiring leaders looking for AI skills related roles. So that's definitely a huge demand in that space. We're also seeing hiring rate picking up slightly. Quarter on quarter, it's just been a 9% increase, especially in talent hubs, country like Singapore and across the board. There's been a slight tick up in that sense.
So do you get a sense if hiring is slightly ticking up now that we've seen the worst of the layoffs in the banking sector, or?
I think it really depends on how the job landscape is just kind of evolving all the time. And like I mentioned, the AI skills is in real demand right now, as well as the soft skills and problem-solving skills. So if we see that trend evolving, we also saw that 76% of companies are willing to look for AI skills rather than just experience. So traditionally, people would opt for someone with greater experience, but now they said they are willing to compromise on experience, but opting for AI skills. So there's definitely a trend in that space.
That AI upskilling in terms of AI remains very conceptual, I guess, to many people, particularly of the sort of older generation who are in between jobs at the moment. So when we talk about you need to level up
on
AI, for example, how do I do that? What does that mean, for example, for a mid-career banker who's looking to get back into the job market? How do I make myself relevant again in that specific sense?
Yeah. It's interesting you say that, David, because we actually saw that in Hong Kong stats itself, that professionals in Hong Kong is actually taking the AI. Gen AI is actually one of the top skills that they are learning on LinkedIn learning platform. And we saw that all across the world, that workers are actually aware of what they need to do to upskill in this space. So there is like 300 over courses on LinkedIn Learning itself that is made available for professionals, and you can pick up all these skills.
So you mentioned, I think you said 70% of companies are looking for talent that has these skills right now. I mean, is that just what sectors is that? Is that all inclusive? Is it just tech? Is it banking? I mean, what are you seeing?
It's all across.
It's all across.
Traditionally, when we look at job titles, people tend to look at jobs as titles. But now, I think companies are beginning to look at jobs as a series of tasks that makes up the job. And looking at where are the areas of this task that can be automated and where AI can actually play a role to introduce that part of it to automate and introducing that into the whole workflow.
And do you get a sense that from a sort of policymaker perspective, what do regulators need to do to sort of further the progress on this? Because there's only so much companies can do themselves, there's only so much budgets can do, there's only much people can do to upskill themselves. At some point, the government needs to give the private sector a nudge.
Yeah. We're definitely seeing it all across the countries, like, for example, across Asia-Pac. In Singapore, the government is taking an active role looking into the talent insights, where LinkedIn provide that insights into the skills in demand and where are the skills residing, and taking a very active step in understanding what are the skills needed to actually make this a place where companies can succeed, where they build their presence. In Indonesia, we just signed a deal with the Indonesia government where they mandate that 800 of their state-owned companies has to evolve, and they've chosen LinkedIn Learning as the platform to actually look at how they upgrade their million workers. So that's definitely work that government, companies, and the workers themselves need to work together to really capture this evolving job market.
Yeah, what about in Hong Kong? You're here for the talent summit. I mean, what can Hong Kong do specifically, you think, to attract big talent back to the city again?
Well, the fact that they're having this first global talent summit is a sign of an indication that they are very serious to take an active step to bring companies, talent, and even the government playing an active role to have this conversation. I think that's the very beginning.
All right. Feon, we're going to leave it there, but thank you so much. It's great to see you here in Hong Kong. Feon Ang there, APAC Managing Director at LinkedIn. We got plenty more ahead. This is Bloomberg. Well, here is your China Brief. A look at what's making headlines in national newspapers and trending on social media right now. On the finance front, the Securities Journal saying a likely triple R cut could happen in the second quarter. Now, it cites experts who think a cut is needed to create a suitable liquidity environment for accelerated issuance of government bonds and ultra-long-term special treasury bonds. Meanwhile, the Securities Times cites analysts saying Shenzhen's new property policy could stimulate the local housing market, but not powerful enough, Dave, to boost market confidence.
Yep, more is needed. Markets are now, so SAIC, we're looking at that, of course, out of Beijing news, some news coming through yesterday, I believe, that pertains to, of course, some of the data in Europe, for example. And yeah, we'll leave you to look at other movers. It's actually a quiet day across these markets. This is Bloomberg.